and what needs to be done to assure that things are working properly, risks are managed, levels are acceptable, but also then how do you then feed that back to perhaps the more development impact climate goal folks thinking about that, and then how does that scoring help you think about maybe what more needs to be done to support that client or in the transition. So I don't know if it makes sense of either to now jump to either more the climate department side or keep with the risk department side. Maybe hearing from Effie or Thomas just a little bit more about that how it's being used within the more risks department in that point of view is where we could start next. So either.
Sure, I'm happy to start. So one thing that I would just wanted to make as a statement as a part, so that it's not going to be too boring for you listening to us, is that you're going to hear from the risk side probably a lot of similarities, and one of the reasons is because we talk. Okay, and we talk because we want to make sure that what we do is actually consistent with others and that there is some sort of standardization in what we do. So what you'll hear from me is actually going to be not very dissimilar from what Steve said to some extent, because we use it in largely a similar fashion and with some variations on it. So we actually have these transition scores. We have physical scores actually separately. The main reasons we have physical scores separately is because physical scores sometimes come up as a surprising risk in sectors that you wouldn't think that they would happen, because it could be that the key assets are actually located on a flooding plain or some sort, and it wouldn't necessarily be a risk that wouldn't tally up as much with transition risk. But for transition risk, we have these scores, and these scores are actually then put in every project, and every project is actually scored, and that scoring of that project is then ultimately fed up into our management committees, into our board of directors as well to see. So that they're conscious of what those scores are. And then there's also a notes that either the credit department does, or it's integrated into the documents that are then delivered to our board committees to look at as well. And that's there largely to actually provide them with that information. What we do with it, especially for those that we see that actually have a high score or high risk sectors, is there's two areas that we engage with, and actually those are the actions that we take place. One is actually we look at the structure. So do we want to actually make some changes in the structure? Do we want to actually change how some of the elements of how we're actually looking at this transaction is going to change as a result of this score, and based on the discussions that we've had? Is it possible to do it? And that's very much an interactive process. The second is actually looking at it and saying, okay, in the event that we can't do it for a variety of reasons, then we get into the engagement process. So what is the action plan that we expect the counterparty to do? What is the action plan that we expect the client to do, so that they get actually with a way of minimizing that risk to them as much as they can? There's some elements of mitigations that they may do today. There are others that are not quite on par. Probably just stepping one step back, the EBRD's clients, for the most part, are not companies and are not clients that are actually required to do these. So if you're looking at countries like, so perhaps in the European Union it's one thing, but if you're looking at countries that are in developing markets, these regulations, these actions, these steps are not fully embedded yet. Yeah. And a lot of these countries and a lot of these clients very much rely to some extent on actions that are quite intensive from a fuel or from an energy perspective. And the purpose of how EBRD sees it is the purpose is not to say we're going to stop, we're going to exclude you from today, and then we're going to let somebody else fund it who probably wouldn't have as stringent criteria as us. But we would say we will engage, we will support, we will finance, but you have to show us that there is a clear shift to transition, clear shift into reducing those greenhouse gas emissions, clear shift to following a low carbon pathway, and then we follow through with that. And then that is then being monitored on that's actually being monitored on a similar to how we monitor our other investments and process from that. I think Steve also mentioned that they're looking at a risk appetite statement to put in. That's actually something very similar that we're working on as well. And while they call it the green asset ratio, which is the ratio that the TCFD actually recommends, we have a ratio that's referred to as the GET ratio, which is very similar. It's actually the percentage of assets that from a capital investment, from a capital expenditure standpoint, are actually green. And we have actually a target of having at least 50% of our investments being into that green category, that GET category, by 2025. And hoping that this year it will be around 40%, but we probably have to see where it ends up. And I think the final point, and that's probably sort of a bit of a longer term, and the most sort of pressing point is actually how do we integrate that ultimately in PDs and probabilities of default, because that's where the real impact is going to happen.
Yep.
I think that's something that we're conscious of. That's something that's definitely the aspiration for it to be on. But for those of you who, and the way to do that in some extent is, one, we actually want to be able to test the rating, test the mechanism, get it more qualitative, do some back testing on it, so that we can actually see that we're making sure that the right counterparties are being flagged up, the right projects are being actually scored, and that the methodology has actually been prudently back tested over a number of years. And then you introduce that, and to those of you who perhaps are familiar with the way that financial scorecards are made, is that there's two elements of a financial scorecard. So one element is actually just putting in numbers, okay? So you put in the actual performance numbers of the counterparty, and then you get, and that's part of it. The second part are actually modifiers, which are actually qualitative questions. For example, how do you assess the company's management? How do you assess their liquidity risk? How do you assess their position versus peers? And another one could actually be then, how do you assess their impact of climate risk on these counterparties? And then that comes in as a modifier, which is ultimately going to change that. But before we get to that point, we actually need to actually be very clear on what do we want to actually say, because there's guidance actually on all those modifier questions in terms of how you assess that and on what basis you benchmark that. So that is clearly the aspiration, and that's clearly where we'll be heading. But I think that is probably a number of years away before it comes into that in that PD. But there is a lot of pressure already just by actually publicizing the score, making that score widely available within the bank, within the board, and on projects for the counterparties as well. I'm probably sure that it's not dissimilar from you
Maybe
as
you
well.
can
So.
the last was credit side
Yes.
of the house.
Absolutely. Okay. So how do we use those data? So nowadays, what we're trying to do now is, it might sound a bit dull, but it's just reporting and doing mappings of our portfolio, literally understanding how exposed we are. Because up until now, we just didn't know. So reporting is absolutely key. Understanding where the pockets of risks are in our portfolios, very important, and feeding into the TCFD report. So the French Development Agency actually published its first TCFD report, I think about a month ago, and it includes climate risks in there. So in the future, obviously that will feed into that process as well, with more precise data. So reporting is quite important. What we want to do next is integrating climate risks into the risk department strategy and the strategy of the bank in terms of risk, and that's called the risk appetite framework. So we want to include, we would like to include climate risk into the talks and the discussions around the risk appetite framework. That will be a really very important discussion for the future, and I think that's what will reconcile me with my colleague from the impact assessment side. I think the most important thing we want to do with those scores is actually, as we said already, identifying our clients that are the most vulnerable and then actually providing more financing. So the idea is not actually to reduce risk on those clients that might be the most vulnerable. The idea is actually potentially to increase that risk, hence the link with the risk appetite framework. We need to be aware of the increased risk, and we need to all collectively agree that it is the right thing to do for more impact. And so clearly the idea and the deal that was done with the operations was, okay, you're going to help us doing that new score on physical risk and on transition risk. And then what you will get from that is actually potentially new business, because we will develop new products and new financings on the basis of those assessments. On the topic of credit ratings, I won't go into details in there. I mean, I've got some of my colleagues from the operations there, so I want to leave that stage alive. So I'm not going to make any announcement there. The idea for us at the moment is that we can't fully integrate climate risk into our credit ratings. We've just never managed to bridge that gap. So we've got scores dedicated to climate risks on the side of the credit ratings. It's in the same IT system, so that bears the same kind of importance for people when they go in the risk system. The score is there, but we're not integrating it into the probability of default is not something we're going to do in the short term, for sure. And then in terms of aligning, so Paris alignment, I think the risk approach is absolutely key for us in our Paris alignment strategy, because it's quite a simple topic. In fact, if you're a bank financing non-Paris aligned clients, then you can't really be a Paris aligned bank. I mean, it's it's as simple as that. So it's absolutely key for us. And because at the risk department we look at the client level, well, actually, it's the best place to be doing that assessment and to make sure that our clients are Paris aligned. Very last thing I'll mention, to help our clients being Paris aligned and aware of those risks, what we're working on at the moment is a set of trainings that will be available internally but also externally on the topic of climate risks. They will be launched very quickly. I think the first part of those trainings will be launched next week, and they will be available for also external public. So that's also part of our effort on the topic.
Great, thank you. I think that's great to hear from, of course, the viewpoint of the initiative, where, of course, we'll be happy to share that with all of our supporting institutions, but, of course, more broadly across the financial community. So I guess now we're going to change gears. So we've heard quite a bit from the risk department here, and I think some interesting both very interesting information of how that gets wrapped into the different aspects that the risk department is paying close attention to. But I think there was also a term used of engagement, and then how that is used in that engaging with the client in maybe a project development or a longer term relationship. So now I want to turn to Nicola and Peter, who are sitting perhaps at a little bit in a different part of their institutions than the risk team, to see how the analysis that's coming out of this transition risk assessment and how it's being managed within the risk department then filters into what you're doing. So I guess start with Peter, and then Nicola, we'll hear from you afterwards.
Yeah, I started to recognize I maneuvered myself into one niche of this discussion. So from the impact side, it's okay. I'm fine with that, and I can say that for our risk department people, I think they're on the same track as you are describing. And so I know that they are now. I described our process in KfW. They are now moving from stress testing, piloting, selecting relevant sectors and stuff. They're now moving towards building that database, getting access to external data because we don't have it internally. And sorting it out and how to incorporate this into our eventual ESG risk assessment framework. So, and I fully subscribe to what you just said, Thomas, about creating more transparency. It's about reporting. Because this is something which I feel that we in all our business units in KfW still need to a large degree, because awareness about these risks is not the same as it is for other risks. That affect our business and that affect our impacts. And we face this challenge also in the development bank, where people are, I think they have grown to understand that physical climate risk is a serious driver for losing impact of the projects, but they are not that much aware of transitional risk. So there's a lot that needs to be done, and we are trying right now from our side, our sector policy division side, to make transition and physical risk a mandatory risk category in all our reporting, also to the German government. Yeah, so far it's been not mandatory. Yeah, so people can write about it, and they don't have to. And I think this is a crucial step, that people actually get to have a vote on this. Yeah, and then we have a second vote from the risk people, and then we are in a discussion. I think that's really where we need to go. So basically, that's what I wanted to say about this.
Okay, great. And Nicola, I guess we'll turn to you now to see. I mean, of course, I don't want to put anyone in a box of what they have to talk about today. But in terms of, again, thinking about how all of the results and then even sometimes the input from perhaps the more risk teams feed into, again, the impact-driven side of how, again, supporting clients and supporting countries and societies transition.
Yeah, great. No, I think it's a very good point, and I think it features both in terms of how we approach this, in terms of our, I guess, portfolio analytics process, but also when we make new investment decisions. So, as I already mentioned, before, we have now the emissions profile of our portfolio, across the board, obviously with data limitations, I guess, that we all have to deal with for a while. But we really see this, as the key opportunity to think about, within the portfolio, what are the kind of, key hotspots in terms of transition risk. And this is not only about the emissions profile, of the investment, but also, the transition plan that it has in place, or that the company has in place. As Effie mentioned, I think that's quite important. That transition risk is not necessarily the same, as the emissions profile itself. So I think what we really want to do more is to think more, how can we engage them, on these transition plans? How can we actually support them, through training, but also, for example, through maybe additional support to finance actually, these sorts of transition measures as well. So I think that will be really the next step for us to really take, what we've done in terms of the emissions data, to really think about, okay, what our engagement strategy will be with those sorts of companies that have been identified. And then on the kind of new investment and new transaction side of things, I mean, for us, really, we think that, looking at transition risk really helps us, to make better investment decisions, again, in the first place, to really also, protect the development impact that we want to achieve with that sort of investment. Because if the business is not viable in the long term, it also, won't deliver the development impact that we envisaged. So I think it really should improve it. It also should give us the entry point to engage with the company as well. We place a lot of emphasis on, value-add activities in addition to the finance we provide, and, working with the client on that sort of transition pathway is actually key. And then the last area that I wanted to mention as well, in addition to engagement, is also, I think, for us, this gives impetus to new product development actually as well. Because do we have the right sort of tools in place to actually help, our investee companies, our future investees, to actually deal with the transition? Do we need to think about, more sorts of resource efficiency support? Do we need to think about some sort of transition finance that we haven't done so far? And I think that will be the kind of, I guess, the next step for us to also think about how can we actually integrate this into product development to support the transition as well.
Great, Nicola, and I see what you've said has definitely sparked interest. So Peter, I think Peter, you wanted to come back.
There was one thing I wanted to throw in as well. It's about client engagement and about your, say, working with a client that is on a transition path. And this is, of course, I was talking about the sector guidelines earlier, and so we are right now working on the 7th guideline, which is for corporate finance. And what we're looking at right now is science-based target initiative. So this is something which we are studying, whether we can use it as a qualifier for a partner or enable a partner to actually adhere to SBTi in order to work with us on a transition path that is then having a reduced transition risk. So this is something where we are moving, where we're trying to find a way of dealing with partners who are actually maybe too high risk. Say a carbon-intensive utility you want to work with, and you want to embark with them on a transition path towards carbon neutrality, but somehow you have to find a system to measure that. So this is something that is also happening.
Well, I think we're now approaching the last 10 minutes of our event, and I'm now having to squeeze both questions and answers and hearing from our colleague Bella from CPI into that last 10 minutes. We unfortunately didn't dive much into the Paris alignment and that connection between Paris alignment and climate risk topic. So perhaps what I'd propose is just to see if there's any questions in the room, and then we can ask our panelists to respond quickly, both in response to that question, maybe a word or two on that connection between Paris alignment and climate risk. So, or if there's no yes, question over here. I don't know. We have normally we have a microphone. Yes, thank you, Rainer.
Hello?
Yes.
Yes, good morning. Thank you very much. It was a very informative session. My name is Walid Ali. I'm from the Central Bank of Egypt. So I'm from the other side of the table. I'm on the regulator side. In your discussions, you mentioned that the regulator was having a significant role in your journeys to achieve what you have. We are in Egypt starting by issuing our guidelines for sustainable finance, and that includes definitely the climate change risk and managing the transitional risk. I want to be short, but I want to hear from your good selves. what was the key action that was taken by the regulator that really helped you in achieving your goals or starting your journey in a success? And what do you see, what do you want to see differently? At what actions that you are expecting from your regulators to help you out more? Because we are trying to analyze the bank's point of view in certain areas in order to come up with our own regulatory framework. Thank you very much.
Great question. I don't know if there's any other questions in the room before we... All right, so I might just turn to the panelists. Apologies for those listening online. As always at a COP, you end up running short on time. So what I'll do is ask our panelists to, briefly respond both to the question from the Central Bank of Egypt, thank you very much, as well as if you have anything to add perhaps on this topic of that connection between climate transition risks or risks in general related to climate change and Paris alignment. So just because it's been a while since we've heard from them, I'll say our EIB colleagues online. Perhaps we can start with you.
Yes, it's indeed a very good question. I mean, what do we expect from our regulators? The IBs, on the EIB, we are mainly in contact with ECB, and I would actually say that the first thing that we expect is not much. I mean, guidance, of course, is important, but also a regular contact with our regulator, because it's just through discussion that we can improve ourselves, and also improve, and also maybe also the regulator. It's also important for the regulators that they get a little bit our feedback, and that they can also adapt accordingly. So to me, what the first thing I would actually expect is availability, which is of course also linked to guidance, but available so that we can discuss with them, so that we can actually brainstorm together with them. And so that we can actually also see whether the approach that we are taking suits them and is okay with them. The second thing that we also expect from our regulator is indeed on the methodology. So we also know that the ECB, they have been very helpful with that. They really they had invested a lot in their staffing, and also have invested a lot in their IT, so that they can do a stress test. And this was also very helpful for us, first to see the results of the stress tests that they undertook, and also to also see the methodology, which they also published just lately. So it is important that we also, because they have, and actually in our case, they have invested a lot in the stuff. They had invested a lot in the technology and in the data. It's important for us that we get the regular help on this, regular feedback on data and on the methodology. Also bearing in mind that they have access to banks much easier than we have, so it's really important. The networks that they have is important for us. So I'm not sure, Max, if you have another thing in your mind, but for me these are the two essential elements.
Great, thank you so much. Now, perhaps I guess Nicola, we'll go ahead and keep it with those that are online and see. Either both on this question of what was that key signal from the regulator that really tried to push forward on this, or again, if you want to say a couple of words, as again, I know CDC Group is thinking quite a bit about this right now on that connection between climate transition risks and Paris alignment.
Yeah, maybe I focus on the Paris alignment question, because I think Steve covered the regulatory aspect really well. So I guess for us, Paris alignment and climate risks, they are very closely linked. Obviously, they require different considerations, but they interact with each other. So if I look, at our climate change strategy, we set out our approach to Paris alignment along the 3 building blocks of net zero by 2050, supporting a just transition, and supporting, adaptation and resilience as well. And you can see really that climate risks, both on the transition risk side and the physical risk side, you could say feed into these building blocks. So on the transition risk side, that clearly links to the net zero building block. And again, similar to our approach, in terms of climate risks, our net zero approach is also both at portfolio and transaction level. So we made a commitment that our portfolio will follow a kind of 1.5-degree trajectory aligned with the trend, and will reach net zero emissions by 2050, the latest, but also that we assess individual transactions for their alignment with a country's pathway to net zero. And I guess transition risk, you could say, features in some way in both of those, because you could say, at the portfolio level, what we will do is we will set out multi-year, basically carbon budgets that align with our long-term trajectory to become net zero at portfolio level by 2050, because it's important to set short and medium-term targets. And you could say, the more Paris-aligned, our portfolio develops, hopefully the less transition risk should be remaining in our portfolio. And similarly, on the transaction side, the more Paris-aligned investments we support, which could either be those investments that are already green, are already very low carbon, or those investments that have a clear kind of trajectory in place to become, green and low carbon, that should also help reduce the transition risk of that sort of investment. So for us, it's very, very closely interlinked, and I think that's why, both of us are kind of key pillars of our climate strategy and how we implement this into our investment processes.
Great. Thank you so much, Nicola. Now, I'll just kind of work my way through the panel back to me. So, Thomas, don't know if there's anything you'd like to add to either what's already been said?
No, I think that was very clear. Just on maybe on the regulator, because we've really seen the impact of the regulator on what we did. I think the regulator is also access to the regulator is a great way to benchmark practices and to benchmark what other banks do. So what the Banque de France did is organizing many workshops, both on physical risk and transition risk with different banks. And then that's a great way to actually meet other banks active in France and understand the way they're looking at that. So creating this kind of forum of discussion is incredibly important, and then obviously organizing the stress test was a key step for us and offered us clear scenarios that we could look at and gave us good kind of clues in terms of methodology as well. So, but yeah, creating that forum of discussion is very important, I think.
Great, thank you, Effie.
I went into that actually on the regulatory aspect because I actually love that question. I think it's exactly what's on our mind at the moment. And as a non-regulated bank, so my answer is actually going to be both in the perspective of actually somebody who's doing the TCFD report and trying to pick which regulatory forum we actually follow. So we look at Banque de France, we look at the Bank of England, because they're sort of the leading, some of the leading regulators on it. And some of the points that come up is, for example, things that are actually starting to emerge now. So having standardized forms, having the clear methodology actually of how banks are doing it so that you can compare the different banks actually that and how they're actually doing it. For example, deciding actually what is the scope that you're going to be doing. So Bank of England, for example, said, focus on your top 100 exposures as well and doing that. Looking at being very actually clear on what is the purpose, what do we actually want to come out of this, because I suspect also both for the Bank of England and for the Banque de France, a lot of the times the regulators or the ECB then came back and said we're quite disappointed with what the banks are coming, because sometimes the banks were a little bit scared in understanding what's the purpose, what is this all going to mean, and that's why by applying some of these sensitivities and how you apply them is actually going to be extremely helpful for them. So I guess in short, it's actually having clear standardized form, clear methodologies, and how that needs to be approached. The stress test and actually understanding who does it apply to, and then of course the engagement with the various banks. But that is really the push that we are hoping to see actually coming. That'll get our banks engaged in doing that. So really welcome that question.
And now Peter.
Yeah, just very briefly, only one aspect I wanted to add to the regulator question. That is, I've talked about this learning journey together initially, and we are fully regulated, learning together with the German regulator. And I think it's important that the regulator is staying abreast with the international developments because there's so much happening, and we see that different systems in different countries make transactions more complicated. So we have this with the green taxonomy, which is not as elaborate yet internationally as regulation on climate risk, but we see that there's a risk of decoupling countries, and then we work in 70 countries worldwide, and if we face 70 different systems, it will be really hard. Apart from staying engaged with the stakeholders, like you were mentioning about the workshops and the stress testing, it's this dimension of being abreast with international developments.
Great, thank you, Peter. And now I'm going to ask everyone for their indulgences to let us run over by a few minutes, as I want to hand things over to Bella from Climate Policy Initiative, who will conclude our event with some reflections on what she's heard and, of course, perhaps some ideas of a way forward.
Thanks so much, Ian, and thanks for the extra pressure to do this very quickly.
No, you take your time, but it's I'm sorry for
No, it's great. This has really been a pleasure. I've learned a lot. I really appreciate all of the panelists and the excellent question as well. I think getting into these details is exactly what needs to happen right now. So let me just try to summarize, reflect a little bit. So first on levers, because I think sort of going back to the beginning of the discussion, there are a lot of really interesting points made, both on internal levers as well as external levers. What is driving this? On the internal side, I think the word I heard from Peter in particular was transformation, internal transformation, and how that was driven from the top. So from the CEO starting a transformation process. The importance of both kinds of risks, so physical risk as well, but transition risk kind of through this analysis, through these transformation processes, actually rising to the top in many instances, or at least on par with physical risk, which was perhaps a bit unexpected for some of the banks. Making this process manageable, using materiality, thinking about sectors, countries, really trying to segment the analysis into smaller pieces to making it actually work. And as a tool, seems that all of these banks are using different kinds of scoring approaches to be able to then assess within those sectors, which are the clients, which are the risks that are most material and really need to be addressed. Externally, some very interesting drivers emerge. I think TCFD, of course, is one of the big ones, especially one of the early ones. Heard about NGFS from several of the banks, really using the NGFS scenarios, trying to standardize across banks, what are these scenarios that they're using. And finally, in some contexts, the regulators and the way that they're conducting stress tests, also the way that they're bringing together different banks. So quite interesting discussion on the levers, both internal and external, what's really driving action. Of course, then the question is in the details. The devil's in the details. Where do we go from here? I liked something that Nicola said, which was on transition risk not only being about the emission profile, but also the plan. And of course, then the question is, well, what is a credible transition plan? How do you deal with all of the uncertainty on the drivers that Ian mentioned, the technological, the behavioral, the policy uncertainty? And I think that's especially important at the country level and for many developing countries. The NGFS scenarios don't necessarily are helpful, but they may not have all of the details in particular on policy at the country level. So how do you really assess what is credible? And of course, risk experts are very good at dealing with uncertainty, but it's still quite a challenge. And then the question is, well, what do you actually do with those risk assessments? How does that link up with alignment? So how do you use the analysis to inform investment decisions? And now there will be some investments, I think this is where the link with alignment really comes in, that there will be some investments that are not aligned no matter what. And I think some of the development banks kind of still differ on what that means and which types of investments may or may not be aligned, even from the beginning before you think about the transition risk of others. But then how do you work with clients with high transition risks? And especially as we think about development in developing countries, how do you really help them manage that transition? And how do you not necessarily turn away from clients with high transition risk, but actually help them through the process of managing and reducing that risk so that you can have the positive development impacts that all of these banks are really looking to achieve? And is there dual mission. And I really liked what a few people said around the development of new products, as well as using transparency of reporting on those transition risks to help drive that action. So many good points, a lot of questions, but really appreciate all of the details, and really thank you to all the panelists, and thank you to Ian for inviting me.
Great. Well, cheers. Thank you so much, Bella. Sorry to have added the pressure by keeping things a little bit long and running over slightly, but great performance under pressure. That was an amazing summary. So thank you so much, Bella. Thank you so much, of course, to our panelists, both here in person and who've joined us online. And of course, thank you to all of you who are here listening, either again here or online in the IDFC Pavilion. So that's it for today's event. I think there's one more slide where we're showing the next events of the initiative that are coming up over the next few days. So tomorrow there'll be an event on the UNFCCC official platform, unfortunately only available online as there is no physical space for this event here at the COP. But we'll be looking at this specific question around aligning financial chains and really diving more into how do you actually address the counterparty issues that we're doing in partnership with the EIB and the Global Reporting Initiative, GRI. Then Monday, back here in IDFC Pavilion in the evening. Please come, even if it is the evening, that we'll be looking at the adaptation goal of the Paris Agreement, which you see is a big topic going into 2022, and really how do we scale up action in that space. And then on Tuesday the 9th, again back here in the IDFC Pavilion, we'll be looking at this question of how do you make climate finance work in an uncertain world, and how do you actually address some of these big uncertainty challenges, and what's the current thinking, and what groups are moving forward to kind of help the financial community as well as the broader development finance community on thinking about uncertainty. So thanks again for joining us today, and we hope to see you back here in the coming days.
Thank you.
Thank you. Bye.